What's up, guys? All right, W's, W's. You are W's in the chat. Come on. Okay, so this is a trade I took today. Sorry, I have to hold this. All right, so this is a trade I took today. I took a loss today. All right, I took a loss today on today's trade. I actually shared this trade on Telegram for those of you that are already on Telegram. And if you're not on the Telegram channel, you can join the Telegram channel. All right, so you all can see I shared the trade here and I took a loss on that. Okay, so here is the Telegram channel at like Forex Trade. All right, so do well to join us so that we can trade together. So I'm not like I'm not the type of trader that cover the dark side of it or the bad side of it and then try to show everybody or flaunt profit to everybody for you to believe that Forex works or something like that. All right. So what I do basically is if I take a loss, you are gonna know, and if I take a win, you are gonna know. All right. And I think that's the best way to grow in this industry by telling yourself the truth. Okay. So on yesterday's class, we stopped at sorry, I have to open my PDF. We stopped at market structure, right? So on yesterday's class, we stopped at market structure, okay? And we have explained what basic market structure looks like. And yeah, W's in the chat, guys. W's, W's. Okay, W's. Share the link, invite more people. Let's go. W's. Make sure you're liking the live stream. Okay. So on yesterday's live stream, we talked about market structure, all right, and the basic market structure, what market structure looks like in the market, and how to spot market structure. All right. Now, in today's class, we are going to dive down into break of structures and change of character. And after that, then we will dive into internal structure, like external structure and internal structure. All right. So let's get started. Okay. W is in the chat if you're active. W is in the chat if you're active. WFX in the chat if you're active. Let's go. W is in the chat. Let's go. If you're active. So I'll just get rid of this now. Okay, I'll get rid of this so we can continue with today's class. Let me take screenshot of that first because I haven't taken screenshot of the outcome of the trade I took. So it won't be that I take screenshot for only trades that plays out. All right. So the first rule to grow in forex trading or in any industry is by telling yourself the truth and taking accountability of anything that you does. All right. Okay, I'm done. Okay, so let's continue. Now I can get rid of this. So when we talk about market structure, so when we talk about market structure here, we say that in a bullish market scenario, we have what we call higher highs and higher lows. All right. And in a bearish market scenario, we have what we call lower highs and lower lows. Are you guys following? So we have what we call lower highs and lower lows, all right? And we say that a bullish market looks something like this, where price is printing a series of higher high, higher low, higher high. Why is it called a higher high? Because this high is higher than the previous high, all right? And then we have a higher low. Why is this called a higher low? Because this low is higher than the previous low. Are you following? Because this low is higher than the previous low, all right? All right. So now, and in a bearish market scenario, we say that we have lower highs and lower lows, all right? So this is a lower low. Now we have lower high and we have another lower low. So why is this called a lower low? Because this low is lower than the previous low. Are you guys following? Am I communicating? And we after a lower low, what do we expect? We expect a lower high, all right? Why is it called a lower high? Because this low here is lower than the previous low. Are you guys following? Are you guys following? So this is it for a basic market structure. So after the lower low, after the lower high, I mean to say, we have a new lower low. Am I communicating? So now, and I showed you guys a chart example of this. I showed you guys a chart example, okay? For instance, this market scenario here, you can see a series of lower low and lower highs, all right? Lower low, lower high, lower low here, lower high, lower low, lower high, lower low, and so on and so forth. So if you take this diagram out now to a clean surface, you will see that this diagram portrays a downtrend, because when you take a trend line tool to mark out straight line, you will see that the line points downward, all right? So that signals a downtrend. Downtrend, which means that the market is moving down, all right? The market is trading down at the moment. So that's it for a bearish market scenario, and that's an example of a bearish market scenario in real chart. Are you guys following? W's in the charts. All right. Now let's look for a bullish market scenario. I want to see a clear bullish trend. Okay, so it won't confuse you guys. All right. All right. Now see here. If you look closely, you will see a series of higher high here. All right. Higher lows, higher low, higher high, higher low, higher high, higher low, higher high, and so on and so forth. All right. And if I should take this diagram out to a clean surface, you will see, yes, the diagrams don't usually be straight the way it's being drawn on a textbook version. Are you guys following? It's not always straight, but this is what it looks like. All right. How do you know? When you take your trend line tool and mark out straight line here, and mark out straight line to follow the lows, all right, to touch all the lows while it keeps going up, you will notice that it's pointing upward. So that signals a bullish scenario. That's a buy trending market, all right? So in this case, what should we be looking for? We should be looking out for a buy opportunity. Are you following? A buy opportunity. That's what we should be looking out for in this particular case. And in the opposite, which is the downtrend, the last diagram that we drew, what we should be looking out for there is a sell opportunity. Are you following? W's in the chat. W's in the chat. Tap your reaction. Tap your reaction, guys. Tap your reaction. W's in the chat. Come on. All right, let's continue. Let's continue. So after this revision, that takes us to today's topic. All right. And today's topic is break of structure and change of character. Are you following? Break of structures and change of character. So what is a break of structure? I explained a little bit of it yesterday. saying that a break of structure is when a swing point is being broken. All right, when a swing point is being broken. For instance, in an uptrend, right? For those of you that already have the PDF, you can see this there. So in an uptrend, when the market is printing a series of higher high, higher low, now for this thing to for it to be seen as an uptrend, we need to break this previous swing point. All right. What is a swing point? A swing point is a point where market reverses from, where market change direction from. All right. So here we have a swing point that is pointing down, all right, and we have the upper swing point here that is up pointing up. Okay. So where is our swing point here in this diagram? Our swing point, yeah. So where is our swing point? One, we have swing point A here. Okay, in an uptrend scenario, this is our swing point A, all right, and this is our swing point B. Are you guys following? So in an uptrend scenario, that's our swing point A, which is the first swing point that led to the pullback, okay, for price to print the swing point B. For price to print the swing point B, all right. So now for the uptrend, for this market to consider um to be considered that is still trading up, what do we have to see? We have to see the swing point B leading to a break from the swing point A. Okay, the swing point B leading to the break of the swing point A. Now, how does that happen? The swing point B here, after price creates the swing point B, price will start buying. Okay, now this is the swing point A, this is the level of the swing point A. All right, so here is the level of the swing point A. For this price to consider a bullish market, this swing point B should lead to the break of this level here, the level of swing point A. All right, so this break here is called a break of structure. All right, this break here is called a break of structure. Okay, W is in the chart. Am I communicating? Is anybody lost? Am I communicating? Is everybody lost? W is in the chart. W's. Am I communicating? All right. Now let's continue. Okay. Now, I didn't mean say that we have gotten our swing point B here, leading to a new break, which we called our break of structure. All right. This break of structure here, once price start reversing back, okay. Once price start reversing back, now we have a new swing point A. Do you understand? Now we have a new. I have to take this here. Now we have a new swing point A at this level. Okay. As you can see at this point, we don't have our swing point B yet until price start pulling back again. Price start buying from any. I don't want to confuse you guys, so I will not start mentioning demand at this level or how to spot demand here. So let's just cover the break of structures here for now. All right. Now, until price start buying from here, giving us a new swing point B at this level. All right, giving us a new swing point B at this particular level. Okay, so this swing point B here signals a continuation. All right, and once price is able to push up or buy to the extent of breaking out from this level, to the extent of breaking this level, this swing point A level, all right. Once price start buying and breaks out this swing point A level, that still signals that we are trending up. All right, that signals that we are still trending up. Okay, so the trend continues until we have our swing point A. All right, until we have our swing point A here. until we have our swing point A as usual. But in this case, price gives us maybe a swing point B, okay, a swing point B here. But this swing point B is not able to break this swing point A level. Are you guys following? It's not able to break the swing point A level. Now it reverse and break that's our swing point B, our previous swing point B, not the new one. Are you guys following? Hope you are not confused. Hope you guys are not confused. Now it breaks the swing point B, okay, the previous swing point B. And once we get this previous swing point B break, this signals a change of character, no longer a break of structure. It's a break of structure, but we call it a change of character. Why do we call it a change of character? We call it a change of character so that you will know the difference. So let's say that a break of structure is a trend continuation, all right? While a change of character is the trend reversal. Okay, so whenever we see a change of character, what is that telling us? It's telling us that a potential downtrend is about to begin. Okay, a potential downtrend is about to begin. That's what it's telling us. Are you guys following? Are you following? W is in the chat. Come on, W's, W's. Yeah, from bullish to bearish. You are following from bullish to bearish. Okay. So this is what we mean by a change of character. So what is a change of character? A change of character is when price reverse from bullish market to bearish market. Okay? When price reverse from bullish to bearish, or when price reverse from bearish to bullish. All right? When price reverse from bearish to bullish. So that's what we mean by a change of character. Are you guys confused? Any question about break of structure or change of character? Any question? Any question? All right. So I should write on. If there's no question, I should write on, right? So I should write on. Okay. So we have covered the break of structure and the change of character. See, you see this particular topic now, master it, understand it. This is kind of the key, this is kind of the key to whatever that we are learning here. This is the most important in whatever that we are learning. All right. This is the most important in whatever that we are learning. Now, being that we have understand the basic market structure, now let me explain, or let's go into types of structure. All right, because we have internal structure and we have external structure. Okay. Now, what do I mean by internal structure? Internal structure are the ones that I just explained right now, the ones that are giving us the swing point A and swing point B. All right. The internal structure is the one giving us the swing point A and the swing point B. While the external structure, okay, now after getting our swing point A here, well, let me delete this. Let me get rid of this, okay? You can take screenshots if you don't have access to that PDF. You can take screenshots if you want to. All right. All right. So our external structure at this point is our swing point A here to swing point B. All right. So now let's say this is our swing point A. Okay. For an uptrend, here is our swing point A, or okay, let me use this one as our swing point A here. Okay, this is our swing point A here. All right. Then we got our swing point B here. All right. So this is our first swing point. Okay, swing point A, and then our second swing point B. Note, a swing point is a level where price start reversing from. Okay, now we have this swing point, but when price wants to reverse, it will not start reversing like the textbook version, just go straight like this. No, when price want to reverse, you will start seeing another uh, trend inside that our string structure, inside that our string zone. All right. Now, what do I mean? The trend that you start seeing, for instance, on a bullish trend, all right, on a bullish market scenario, when price wants to start reversing or start a pullback, you start seeing a bearish market. All right, you start seeing an immediate bearish market. So how does that happen? You start seeing a series of lower low, lower highs, lower low, lower high, lower low, lower high, lower low, lower high, till we get to a certain level, all right, and then price will now start buying to break structure, signaling a continuation on the bullish market. Are you guys following? Are you following? Are you confused? Is anybody confused? Is anybody confused? All right. Until start price breaks the previous swing to give us a new swing levels. To give us a new swing level. So how does that happen? Now, this is a bullish market. Okay. This is a bullish market, and the bearish market is opposite of it. All right. The bearish market is opposite of it. Let me explain this again before I show you guys on the chart. All right. Before I show you guys on the chart. Now, on a bullish trend, we have our higher high, all right, our higher low. We have our higher high here. Okay. Now, our market wants to start reversing back for a pullback, all right, for a correction. Some people call it correction, some people call it pullback, some people call it reversal. It's all the same, just different names. All right, all the same, just different names. Okay. Now, after we get a break of structure here, all right, now we have our swing point A and our swing point B. Okay, now we have our swing point A and our swing point B. Now, why do this correction happen? Do you remember when I say you should get familiar with the keyword mitigation? All right. So after an impulsive movement, price reverse for the big bands to break even on a losing trade before they continue. Okay, before they continue. So now we will start having a series of lower low, lower highs, lower low, lower highs, lower low, lower highs, then boom, higher high. All right, then boom, higher high. So what that typically means is for the fact that price is between these two swing points, our swing point A and our swing point B, price is still bullish. Do you understand? Even though we are having bearish trend, like internal bearish trend, price is still bullish for the fact that price is still between our swing point A and our swing point B. Do you guys understand? Are you following? If you understand, W is in the chat, tap your reaction button. W is in the chat, tap your reaction button. Okay. Yeah, the major trend is still bullish. All right. So even if you are seeing a bearish market scenario, the major trend is still bullish. Should I move on so that I will show you guys chart example? On a bearish trend, the bearish trend is the opposite of the bullish trend. So instead of covering the bearish trend, let's use our time for another thing. All right. So just know that the bearish is the opposite of the bullish. Okay. Now let's continue. Let me wipe this out. Oh, I did not show you guys break of structure and change of character in real charts. Okay, so before we continue, let me quickly show you guys break of structure and change of character in real charts. Then after that, we just covered internal structure and external structure. Then after that, we touch a little bit of liquidity before we end the class. So tomorrow we are going to continue from liquidity. All right, we just touch the basic liquidity. Then tomorrow we continue. Okay. So now for the break of structure, okay, here is a typical example of internal structure and external structure, right? Now we have a break of structure at this level. Okay, we have a break of structure at this level. All right, so where is our swing point A? Here is our swing point A, and here is our swing point B. Okay, so for the fact that price is between these our two swing points A, for the fact that price is between this our swing point A here, all right, and our swing point B here, okay, we are still bullish. Now you see that when price start pulling back, what do you notice? You notice a bearish market scenario. All right, you notice a bearish market scenario where price is printing a series of lower low, lower low, lower high, lower low, lower high, lower low, then boom, higher high. Are you guys following? Are you following? Do you understand this? Should I come again? Should I come again? Let me show you guys another example. Okay, I should come again. All right, let's look for another example. Let's look for another clear example. Okay, now this is another example here. This is another example. After this break of structure here, all right, after this break of structure here, you notice that price starts printing a series of lower low here. Price starts printing a series of lower low, lower highs, lower low, lower high, lower low, lower high, lower low, higher high, then boom, we have another break of structure. Okay, and again, here is another example. After the break of structure, price wants to reverse, we start having lower lows, lower high, lower low, then boom, break of structure. All right. So just know that after a major break, after a major swing break, we will have what we call a pullback or a reversal or a correction, all the same, just different names. Then after that, that pullback or correction will have a series of the opposite trend before price continues to the intended direction. Are you with me? Before price continues to the intended direction. So this is a market example of it. All right. That's a market example of it. Okay. Now, what else did I say we are going to touch here? We are going to touch a little bit of liquidity. Are you guys okay with the market structure, the internal structure, the change of character, and the break of structure? Are you guys okay with that? Should I move on? Because I want to touch liquidity a little bit, and then we move to the next. We call it a day and wait for tomorrow. Should I go ahead? Let's move on to liquidity. Okay. So what is liquidity? Uh, So what is liquidity and how do we identify liquidity? So in simple terms, liquidity is money. All right. Liquidity is money in the market. Where there is money, where there is resting pending orders, where we have huge orders. In fact, liquidity is what moves the market. Are you guys getting me? Liquidity is what moves the market, and but that does not mean that every liquidity that we see is tradable. All right. That does not mean that every liquidity level that price must target to that point. So there are types of liquidity. Number one is stop loss, right? Number one is stop loss. Okay. Pending orders. Pending orders, type of pending orders, we have stop loss. Stop loss is where little traders exit from a losing trade. All right, is where little traders exit on a losing trade. For instance, why I started when I was starting this live stream, I showed you guys that I hit stop loss. I lost a trade today. All right, I lost a trade today, and that's how I wasn't there to close the trade on my own. I just set the stop loss. All right. So once you set stop loss, that automatically means that your stop loss level is liquidity. Do you understand? Does that mean that the market movers, the big banks, must grab every liquidity before they move? No. Some liquidity are not just yet ready to be taken. Do you understand? Do you understand? So now, types of liquidity, we have structured liquidity, all right? We have structured liquidity, we have trend line liquidity, okay? We have trend line liquidity. All right, those with the PDF, go through it and understand more. We have trend line liquidity. So what is a trend line? A trend line, uh, like the way we have already talked about structure. All right, the way we have already talked about structure and how market moves when market is in an uptrend. So for you to know, you can draw your trend line, a vertical line. All right, a vertical line, draw your trend line in order to spot the direction of the market. Are you guys following? In order to spot the direction of the market. So now we have trend line liquidity, we have Fibonacci liquidity. What's Fibonacci? We have Fibonacci liquidity, all right? But all these levels, I don't normally use Fibonacci again. I don't really use Fibonacci. I do use trend line and then structure, all right? So liquidity. Now let me go to my PDF to read out the theory. So we are on liquidity, all right? So here's are some examples. We have double top and we have double bottom, all right? We have double top and we have double bottom. We have trend line and then we have Fibonacci, all right? We have trend line and then we have Fibonacci. So double top, why is it a liquidity? Is a level where price has mitigated twice. So there is a huge pending orders there because your stop loss, a buy stop loss is a sell order and a sell stop loss is a buy order. So when you buy the market and on a losing position, you are stopped out by a stop loss, okay, because you set stop loss, so you get stopped out. Now that stop loss that you set, when it triggers, it changes to a sell position. Yes, you are no longer in the market, but that your initial order changes to a sell position. Are you following? Are you following? So 50% double top, like I said earlier, double top here, where price has touched twice or more, where price has touched twice or more is a liquidity level, a potential level that price will come and grab liquidity from. You don't understand? All right, let me break it down. Okay, let me break it down. Now, imagine bouncing a ball. Okay, you bounce a ball and then you set your hand on a certain level, all right? Now the ball bounce on the ground, comes to your hand, touch it, bounce again, comes to your hand, touch it. Now that is a double top, all right? Because on that level of your hand, that ball has reached that level twice without breaking it, okay? Without breaking it. Now in the market, what the big banks does is when they come to that level, they will break it and then have a quick reversal. Are you getting me? They will break it and then have a quick reversal. Now, why did they break it? They break it to take out all the orders there because they need liquidity to move the market. Okay? And why did they need liquidity? They trade huge amount of money. All right? They trade huge amount of capital. So they cannot execute all their trades. If they want to buy, let me say, $1 million worth of Euro USD, all right, $1 million order worth of Euro USD, they need 1 million order sell worth of Euro USD. And no, someone cannot just come to the market to sell or to buy 1 million order worth of or 1 billion order worth of Euro USD. Do you understand me? Reason because because if that happens, the move in the market will be very, very obvious. It will be very, very aggressive. Are you guys following? So now what do? They start selling. All right, they sell to the retail traders, triggering their stop losses, triggering pending orders in order to achieve what they need and then reverse the market to their direction, to their intended direction. Are you getting me? So if they want to buy, they will start selling first, okay, and then they will now buy. All right. So when they bought, that reversal that we normally say is a mitigation. Like I said earlier, mitigation reversal is a mitigation where the big banks break even on a losing trade. So all those sell that they triggered before they bought, when they reverse back, they are breaking even on a losing trade because they will be on a loss because of those sales. All right, they will be on a loss because of those sales that they did that they initiated before they bought. Do you guys understand now? Do you guys understand? So they need liquidity to move the market. All right, they need liquidity to move the market. Tomorrow we will dive more and market example of all this liquidity that I'm explaining. Okay, so W is in the chat, guys. W is in the chat. W is in the chat. W's, W's, W's. Can someone type Larry FX in the chat? Let's go. Yes, every double top or double bottom is a potential liquidity to grab. All right. Every double top, double bottom, triple top, triple bottom is a potential liquidity to grab. All right. So I hope that answers your question. Any question? Let's call it a day and continue tomorrow. Any question? Is there any question? Any question? So you can call it a day. If there is no question, W is in the chat. WFX. No question. WFS in the chat. Let's call it a day. So before we call it a day, go to Telegram if you are not on our Telegram community. All right. If you are not on this Telegram community, because this is the only Telegram community we have, come to Telegram, search of Larry Forex Trades. All right. Search of Larry Forex Trade and join the Telegram community. Okay. To join this discussion group, you can see other traders here discussing. All right. You can see different traders here discussing. Click on comment on any post. All right. It will lead you to the discussion group. The discussion group is private. Okay. So go now, join the Telegram. All right. Join the Telegram. And if you want to message me, you can message me at Larry Forex. Okay. At Larry Forex on Telegram. All right. So thank you for joining, guys. Let's call it a day. This video will be available here on YouTube, so you can always rewatch it and learn more, take notes. And then for the broker, make sure you sign up with the broker link on the Telegram community. All right. Make sure you sign up with the broker link on the Telegram community. See you guys tomorrow. Let's call it a day.